All right, let's talk about Figma. On September 3rd, they dropped their Q2 earnings, and on paper, it looked amazing. I mean, a solid beat on revenue, a beat on profit. So, why on earth did the stock get absolutely crushed? In this explainer, we are going to deconstruct Figma's earnings call to figure out what the market hated so much and what it tells us about where the company's headed. So first, let's just look at the big headline number. $249.6 million in revenue for the quarter. That's a massive 41% jump from last year, and it sailed right past what Wall Street was expecting. Operationally, everything looked great too. Strong cash flow, more customers. By any normal measure, this was a fantastic report. But then, this happened. As soon as the market closed, the stock just fell off a cliff, down over 14%. So what gives? How does a company that beats expectations get punished like this? Well, to get the real story, you've got to ignore the headlines and dive right into the nitty-gritty of the earnings call. Yeah, see, this whole sell-off wasn't really about the quarter they just finished. It was all about what's coming next. Investors got spooked by three big things that came up during the call. So let's break down exactly what those were. Okay, the first red flag for investors was the guidance. Management said they expect to grow about 33% next quarter and 37% for the whole year. Now, you're probably thinking, wait, that sounds awesome. And you're not wrong. But here's the thing. For a high-flying stock like Figma, the market doesn't just want good. It wants mind-blowing. This guidance was seen as just fine. It was in line, and that's not enough to get investors excited. The second issue was all about the profit margins. You know, management was super clear that they're about to spend a ton of money on AI, especially for their new products. And what does that mean? It means huge bills for all the computing power needed to run these fancy AI features, and all that spending is going to take a big bite out of profits. And they weren't trying to hide it either. The CEO, Dylan Field, said this directly on the call. It's a classic playbook, right? Spend money now to grow bigger later. But all the market heard was lower profits are coming. And, well, that's a surefire way to scare people off. And finally, we have what analysts call a technical overhang. Now, this has zero to do with how well Figma is doing as a business. It's all about the supply of its stock. See, after an IPO, there's a lockup period. And when that ends, a flood of shares from early employees and investors can suddenly hit the market. And this isn't just a one-time thing. It's going to happen in waves. The lockup for the big venture capital investors expires in stages, starting soon and stretching all the way into mid-2026. This creates this constant, predictable threat of more shares for sale, which can really weigh a stock down. Okay, so that's the bear case. That's the stuff that drove the big sell-off. But it is only half the story. On that same call, Figma's management laid out a really ambitious plan for the future, all about innovation and winning the long game. So let's flip the script and look at the bull case. I mean, check this out. At their big conference recently, Figma basically doubled their entire product lineup. They launched 4 brand new major products: Figma Make, Draw, Sites, and Buzz. This isn't just a small update. This is a massive, massive expansion of what their platform can do. And this quote from the CEO, this is everything. This is the core of their entire strategy. They're betting that as AI makes it easy for anyone to code, the one thing that will make a product successful is incredible design. They're trying to position Figma as the absolute center of the universe for what matters most in this new AI world. And they've got the data to back it up. There's this super important metric called net dollar retention, and Figma's is an amazing 129%. So what does that mean? It means their existing customers are spending 29% more money with them this year than they did last year. It's the ultimate proof that their land and expand strategy is working perfectly. People come for one thing and end up buying the whole suite. So here we are. We have 2 totally competing narratives. You've got the market obsessed with short-term problems like guidance and margins, and then you have the company totally focused on innovation and long-term domination. So how do we make sense of all this? Let's put it all together for an analyst's verdict. Okay, looking ahead to the next earnings report, here's what we're watching. Management guided for revenue between 263 and 265 million. Our bet is they'll hit the high end of that, thanks to those new products getting some traction. But honestly, the number itself won't be the main event. All eyes are going to be on the full year forecast and, you guessed it, what they say about those AI costs hitting their margins. So, putting it all together, our official equity research style rating for Figma right now is market perform. Now, this is not a buy call, but it's not a sell call either. It's basically us saying it's complicated.
The company is doing a fantastic job and their long-term vision is super compelling, but that expensive valuation, the pressure on profits, and all those shares waiting to be sold, those are some serious headwinds that could keep the stock from flying high for a while.
A market perform rating is one of the trickiest things on Wall Street. You see the good, you see the bad. It's a messy picture. So the big question is, how does a professional analyst actually turn a view like that into a trade? Well, if you were a hedge fund analyst, you might pitch something called a pair trade. In simple terms, it means you'd buy Figma stock because you believe in the company's growth, but at the same time, you'd bet against a basket of other software stocks. The whole point is to bet that Figma will do better than its peers, even if the entire tech sector has a rough time. It's a clever way to bet on Figma's strengths while protecting yourself from the wider market risks we've talked about. So there you have it, the full story behind Figma's Q2 earnings roller coaster. And just a quick reminder, of course, that everything in this breakdown is for educational purposes only. This is not financial advice.